Welcome to the Explainer. Okay, let's just say it. We are in the middle of a massive boom in artificial intelligence. Some people are calling it a once-in-a-lifetime chance to build incredible wealth. And you know what? They might be right. But what if? What if it's just a familiar story? A bubble that's getting ready to pop all over again? This quote from the legendary investor Sir John Templeton really gets to the heart of it, doesn't it? The hype around AI, it feels absolutely incredible. And it's easy to think, no, this time is different. But is it? Or are we just watching history rhyme? To really understand what's happening today, we've got to rewind the clock. Let's go back to the year 2000. It's a bit of a cautionary tale, for sure. A story of hype, hope, and a historic market crash that has some seriously powerful lessons for us right now. So, picture this, the dot-com roller coaster. For a couple of years, it was an absolute frenzy. I mean, money was just pouring into any tech stock with a catchy name, and pretty much everyone felt like an investing genius. Then, boom, in 2000, the bubble burst, and the collapse was just breathtaking. The Nasdaq ended up losing almost 80% of its value. And here's the thing you have to remember. This wasn't just numbers on a screen. The fallout was real. When all the dust finally settled, less than half, only 48% of these supposedly revolutionary dot-com companies were even still around. It was a brutal reality check. So, let's fast forward to today. That same manic energy, it's back. You can almost feel it in the air, right? But this time, it's not the internet that's driving all the excitement. It's AI. And that's because right now, the fate of the entire stock market is pretty much tied to just 7 companies. And they are all locked in this massive, high-stakes arms race to completely dominate the world of artificial intelligence. You've probably heard of them. They're called the Magnificent Seven. That's Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and NVIDIA. Together, they now make up a staggering 36% of the entire S&P 500 indexed. So yeah, even if you just own a simple index fund, you're betting big on this race, whether you know it or not. So how serious is this arms race? Well, just look at the money. Together, these 7 companies are planning to pour over $330 billion into AI in just 1 year. To put that in perspective, that's more than the entire GDP of a country like Finland. It's just wild. And this chart right here, it just perfectly illustrates the scale of these bets. You've got Amazon leading the charge, planning to spend $100 billion, mostly on cloud stuff. Microsoft is right there at $80 billion, funding partners like OpenAI. And Google is close behind. They are all pushing their chips to the middle of the table, betting their entire futures on winning. But where is all this money actually going? This brings us to a really fascinating and maybe slightly worrying concept that some folks are calling the AI money machine, and I think it might just change how you see those massive revenue numbers. Okay, check this out. It's a circular flow of cash, and it kind of works like this. Microsoft invests billions in a company like OpenAI. Then OpenAI turns around and uses that same money to pay Microsoft for its cloud services. Microsoft then takes that revenue to buy a ton of chips from NVIDIA, and then NVIDIA turns around and invests in other AI companies. See what's happening? Each company gets to report these huge revenues, but it's largely the same pool of cash just moving in a circle. The simplest way to think about it is like this. Imagine you pay a friend $1,000 to dig a hole. Then he pays you $1,000 to fill it back in. On paper, you've both recorded revenue. Your businesses look great. But in reality, no new value is actually created. It's a transaction that looks really productive, but it could be just artificially inflating the numbers. This analogy just perfectly captures the whole situation. You've got billions being spent on the tools, the shovels, the land, the infrastructure. But here's the catch. Many of the core AI companies, like OpenAI, are still losing a ton of money every single month. They haven't actually found the gold yet. That is, a real sustainable profit model that can justify these sky-high valuations. You see, it's this belief in endless growth and future profits that's fueling these massive valuations. But there's a really fundamental obstacle looming on the horizon that could slow this whole thing way down. And this is the key question, isn't it? The entire market is betting that the crazy fast pace of AI improvement is just going to continue forever. But the AI models we have right now, they all rely on one crucial ingredient, data. And believe it or not, we are starting to run out of it. Think about it this way.
You and I, we learn from lived experience, from conversations, from making mistakes, from just interacting with the world. Our data set is pretty much infinite. AI, on the other hand, learns by just consuming all the digital data we've already created. And by 2027, some researchers think that AI models will have consumed nearly all the publicly available online content. It is literally hitting a data wall.
So, okay, knowing all of this, the hype, this weird money machine, the data wall, what should you, as an investor, actually do, right? How do you navigate this whole landscape without getting totally burned? First, and this is so important, play the long game. One of the simplest and most effective things you can do is just set up automatic investments into a broad, low-cost index fund. That's just one investment that holds hundreds of different stocks. The real secret here is not to panic when things get rocky. Historically, the market always recovers, and a downturn is actually a massive opportunity to buy great assets at a discount.
Second, focus on what you can actually control. Your income is a fuel for building wealth. It's that simple. Getting a promotion, starting a little side hustle, whatever it is, that can supercharge your ability to invest, especially during a market downturn when you can scoop up those bargains.
And finally, diversify. This is the absolute key to surviving any market bubble. We've all heard it. Don't put all your eggs in one basket. Spreading your money across different kinds of things, stocks, bonds, maybe some real estate, is your best defense against a crash in any single part of the market.
So, when it all comes down to it, a bubble bursting doesn't have to be the end of the world. In fact, if you understand the dynamics we've talked about today, you won't be the one panicking and selling at the absolute bottom. You'll be the one who's prepared, ready with a shopping cart, waiting to take advantage of the opportunities that always emerge from the chaos.